Hi, so this is my analysis on Nike, and I've realised that as my analyses have gone on, they've got less and less about the numbers in the video. And the reason that I'd been doing that originally was I was kind of worried about making the videos a bit too kind of dry and boring. I think I kind of seem to have gone the opposite way, and they still seem to be quite dry and boring anyway. So what I'll do here is I'm going to try and kind of cover all of the bases. Let me know what you think, whether you think that this format is better, whether you think it's worse. Let me know. All right, this will also likely be one of my last videos for a few weeks, just because I'm going to need to now focus on completing the qualification for eToro for my elite status. So that's why there will probably not be so many analyses going forward over the next couple of weeks. Now, so Nike, when I did this analysis, I started this a few days ago, so I've had to kind of take a snapshot of the business from then, and that's the kind of numbers that I'm working with from here. Now, at the point when I did this, the share price was $143.17, a market cap of 225.7 billion. Now, my price target for Nike is $157, and I've got a hold rating on Nike. Now, my price ratings are 5 years out, and I'll explain this a little bit more as I'm going through this analysis. So when I set my price target, that is what I'm expecting the business to be fundamentally worth in 5 years' time. Now, the current kind of market conditions are setting out companies at the moment roughly at that level. So the markets are kind of putting in 5 years of growth and valuing the company at that. And that's the overall market conditions at the moment. So my price target, like I say, is based on what the business will be fundamentally worth in 5 years' time. That means that if the current market conditions continue, that in theory, this share price should be hit this year. If, however, the market conditions change and reset back to historic levels and back to kind of like the old normal as such, then in theory, Nike should be worth this amount in about 5 years' time. So I hope that makes sense. And that's just a general kind of idea of my price target that I'm giving here today. And it also hopefully might explain some of the other videos if that's not been clear. So with the current market conditions as they are, those of you that have been watching my videos and following me on eToro will know that I'm now very concerned that we are heading towards a correction. I've closed all my positions, and that's why I'm now holding cash or a couple of very small short positions, just while I'm waiting for the market to decide whether it's going to continue on its bull run and continue valuing companies at 5 times, like 5 years earnings, or whether it's going to kind of reset itself back. So let's start with the management team of Nike. So the current CEO is John Donahoe. He became CEO in 2020. However, he has been on the board since 2014. And also Mark Parker, who was the former CEO for 14 years, as well as Philip Knight, who is basically the guy who created Nike. He's still the largest shareholder as well, and both of those guys are still on the board. So the board definitely has a lot of support. Experienced Nike representatives on the board. There is also a very large and very diverse and highly skilled group of individuals that are serving on the board of directors of Nike. Now, obviously, this is very reassuring for the company, because you kind of know that your money should be safe with regards to investing in Nike, because they've got such a strong, experienced and diverse board, they shouldn't be making any kind of rash, silly decisions that's going to suddenly like cause the business to crash. So they're safe in that regard. The only thing that you could argue is that maybe this board is a bit expensive because of the fact that it's such a big board, there's so many people on it. And when I've looked on Simply Wall Street to check John Donahoe's compensation, for 1 year at this company, it's over 54 million, which is way, way above anyone else managing a company of this size. So when I say anyone, the average, it's way, way above the average. Obviously, I don't know every single company, but the average is definitely way above. So then let's look at the company financials. So current share price 143, fair value of 80, book price of 21. Their current value based on average earnings, so using my kind of way of calculating, is using their current average net income, and as you can see here, this is their income sort of like this the last 4 years that have been reported. 2021 we are 3/4 of the way through, so I've kind of estimated the fourth quarter here, but based on these 3 years here, we're talking about a current average net income of 3.2 billion. So with that current average net income, we would expect, based on their average historic price to earnings ratio, a price of about $54.81 based on that price. Okay. Now, based on their current average net earnings and their current market price, this is their current price to ratio. Okay. Actually, I think that's technically actually based on 2020 earnings, so that's why it's ridiculously high. So this I've kind of worked out as an average over about 10-year period of what the average price to earnings ratio is over a 10-year period. Now, like I say, this is all kind of my calculations, how I look at a company's valuation. And this is just to kind of explain it in a bit more detail so that you can understand my thinking and where I'm coming from. So, like I said, 2021, we're 3/4 of the way through, and I've had to kind of predict the fourth quarter there. And then going through, I've then predicted the next 5 years of growth after that. So, all the way up to 2016. Now, when we factor in 2021's growth, right? So if we kind of consider this year's growth based on the net income that would make, based on the average historic price to earnings ratio, that would then give us a price target of a share price of $95.91 with a market cap of 151 billion. Okay, so based on this year's annual net income, that's kind of like the price target that we could set ourselves to say this is what the business is valued at today. Okay, so just to kind of explain that a bit more and to explain my way of calculating, if I had a crystal ball and I was predicting this level of sales 5 years ago, then that would be my price target. Okay, so 5 years ago today, if I'd have known this information, my price target would have been $95.91. Now, Nike actually surpassed that at the end of 2019. Okay, so if we look here, this is Nike's share price. Okay, and you can see here 2019, 2020. So 95, it kind of peaked over 95 in October, came back down, and then by the end of, I think it was like end of November, start of December, it kind of completely cleared that 95 mark, and then basically lasted until the global pandemic. So that's kind of where I'm at. That's kind of the price target here, based on the current price, and if what we'd kind of expect the share price to be sitting at should be around 95, maybe factoring in some growth, maybe 100, would kind of be almost the expected value of this share if it wasn't for the increased 5-year out earnings cycle that we've got in the prices at the moment. So if the market was to kind of correct, potentially we could be looking at Nike going back to a price of around $100 per share, with the idea that by the time we get to 2025, 2026 is when we would get to $150 per share. Is it 100? Yes, yeah, $157 per share would probably be hit around this point if we go back to the normal, the old normal. Okay, so going back, so that was my net income predictions. So based on that, I've then come back to the overall revenue, and this is obviously, again, fourth quarter has been kind of estimated here, and this is where we're looking at with our overall revenue for the business for the past 4.75 years, and what it's kind of looking at now, and what potentially we should be seeing over the next 5 years for this company, assuming no other massive global shock event or anything like that. Then we've got the dividends here, and we're talking about roughly 0.75 cents per share a year a dividend, which when you kind of figure out the fact that you're getting 75 cents for a $143 investment over a year, you're kind of counting in that dividend is a bit ridiculous, really. It's such a tiny percentage, and it kind of really isn't worth investing in this company for a dividend. It only really is like a small bonus as such. So when we look at the actual assets of Nike and how they're broken down, this is obviously all of the assets that are owned by Nike, and then this is the liabilities. So these three here are the various liabilities, and this last section here, the 11.9, is basically 11.9% of this is what you would own as a shareholder if the business liquidated. So this is kind of like where all the kind of money is held within the company, all the assets that are owned, and then that exact same pie chart here, that same amount of money is then duplicated here and broken down to if that business was liquidated, this is where it would go. Okay, so if liquidated, Nike shareholders would only actually get 11.9% of the $36.2 billion of assets that Nike owns. Now, obviously, to an extent, this is a little bit irrelevant because Nike's not exactly going bust anytime soon. The financial situation of the business is completely fine. But I think one thing to kind of notice from this is the fact that the business still has plenty of kind of scope for taking on more debt if it needs it. So breaking down the company now into the different areas that it's operating in, and like I say, again, fourth quarter I've had to estimate, and going forward a couple of years just to kind of estimate and see where that growth kind of comes in. So as you can see, obviously the biggest chunk of the business is coming from North America, and then it's Europe, and then it's China, and then it's Asia. Now obviously Europe is Europe, Middle East and Africa, which is a huge area of the world. But that's kind of where we're sitting at. And when you look at the growth of Europe, Middle East, and Africa, we are talking about quite a lot of growth there, as well as a lot of growth in China. And I see the two kind of main areas of growth for this business is going to be from China and from Europe, Middle East, Africa. So it wouldn't surprise me if in the future this will get broken down further, and it may well break parts of that out, whether it'll be Europe as one and then Middle East and Africa, I don't know, or whether Middle East and Africa is just too small, I don't know. But when you're kind of looking at the growth ratios within this business, this section is looking very tasty. So then we're looking at the way the different areas of the products that Nike breaks down to. I'm saying all of this, obviously all of this document will be on my website. So if you want to come back to this and have a look a bit more detail, if you head over to my website, wes-investments.co.uk, you'll be able to have a look at this in a bit more detail at your own pace. So I've broken down here where the Nike's kind of income is coming from with regards to the product types. So obviously, as you would expect, the vast majority of Nike's income is coming from its footwear. A chunk of it is coming from apparel, and a tiny little bit comes from its equipment. And as you can see, obviously, we've got consistent growth here that I've kind of factored in going in for the next 2 years as well. And when you look at the breakdown here, what we're seeing is actually that footwear is increasing very slightly, apparel is increasing very slightly, and equipment is actually decreasing very, very slightly. But we're talking about such tiny numbers that it's not really that noticeable. Now, equipment is growing, but what I mean by that is footwear and apparel are growing at a higher rate, and therefore equipment is becoming a lower percentage of Nike's income. Okay, so in this graph it's showing that equipment is declining very, very, very slightly, but in this graph we can see again very, very slightly that equipment is actually growing. It's just not growing as fast as the others. So looking at an overview of the company, Nike has a very, very strong brand image, and I think everyone kind of recognises the Nike tick. It's one of the most recognisable brand kind of logos in the world. And it's already so well established in the USA and Europe, and I think, to be fair, pretty much globally. And despite this, despite how long it's been in the market, it's still growing. It's still growing in Europe, in USA, and there's so much more growth, obviously potential in China, and other emerging markets as well. So there's so much potential growth for this company that, say, over the next, I've only calculated up to the next 5 years, but going longer term, we could even see a doubling of this share price over the next, say, 15 or 20 years. Now, I'm not obviously counting that in. I'm not saying that will happen because we can't tell that far out. There's no way that we can predict that far into the future. But that's the potential that's there. There's so much growth potential. Now, talking about Nike's company direction. Now, Nike is very much moving away from its discount lines, and where previously it would have flooded the market with its trainers and keeping its focus on fashion, this has often meant that it's made up a lot of its old stock has ended up having to be heavily discounted, and it's really hard to pay full price for a product when you can see other products that are exactly the same or from that same brand being sold really cheaply. Now, Nike has seen this, and it's scaled back its focus on a few more profitable products. So rather than kind of trying to make trainers for everybody. They've kind of gone, do you know what? Let's kind of get that part of the market. Let's leave that kind of budget end for budget trainer makers, and we're going to focus on higher end, more kind of profitable products. And then further to that, they've also focused on cutting costs, and they've significantly reduced the cost of producing its products, as well as moving to a more direct-to-consumer model, which then skips the third-party sellers, which increases their profits more. So the fact that they've kind of focused on that means that their bottom line is going to increase, which obviously, if it does continue to increase at a larger rate than their sales, so i.e., although their sales may grow 10%, their profits may grow 15%, for example, over any kind of given period of time, which obviously then massively impacts the share price. So we've got that kind of element, and the fact that they've kind of done all of that before the global pandemic meant that when we actually hit the global pandemic, they were already prepared. Now, obviously, they weren't completely prepared. There were still issues that they had because nobody could have foreseen this, but they were as prepared as any business could have been, and they were very much well set up for this. And I think that's a really big part of why they didn't end up being really, really badly impacted as they could have been. Now, obviously, they were negatively impacted because a lot of their kind of retail outlets were closed, and it's a retail business that isn't completely online, although they are focusing on it. So it did take a hit, but it could have been a lot worse if it wasn't for the fact that the business is so well prepared. So that's kind of like my overall view on Nike and where I think the business is at the moment, where I think it's going to go, and the current kind of price target. Like I say, at the moment, I am very kind of untrusting of the market. We're calculating the value of companies 5 years out, which is fine if the market does continue to do that. But when you kind of look at the trends of tech companies which are already being considered as overvalued, I absolutely would argue that in many ways, if they are kind of 5 years out, then Nike, for example, is almost the same level of overvalued. Just because it's got a lower price to earnings ratio, it doesn't necessarily mean that that's sort of like it's not overvalued in the same regard. So that's my thoughts. Let me know what you think. You might think I'm completely wrong. A lot of people do at the moment. And I guess only time will tell how it will pan out. Thanks for watching. I'll see you in the next video.